Thanks for joining us. My name's Adam Stone. I'm here with Deon Westbrook and Mr. Matt Williams. Deon, if you could introduce yourself to the group, please.
Hey, how's it going, everybody? My name is Deon Westbrook, and I'm with a mortgage company called New American Funding. I've been in the business for just about 15 years, and so I love doing what I do. Love helping families, especially people that look like myself, for sure. Achieve the American dream. So I'm here to answer any questions and go over a lot of information, and answer any questions anybody have for sure.
Great. Thanks, Deon.
No
Hey,
problem.
Matt, how's it going?
Hey, pretty good. My name is Matt Williams. Me and Adam are partners in a couple ventures, and I've been doing flips for about 5 to 7 years. Doing actually pretty well right now. So we'll kind of go over that a little later on in this talk.
Great. Yeah, I'm Adam Stone. I'm a real estate and business attorney, real estate broker, growing investor, working with Matt Williams on projects located and based out of San Diego to start, but we're hopeful and confident we'll be out of San Diego within the next few months. But we're here today to talk about the moratoriums, the forbearances, a lot of the changes that have come into place with the laws based on the coronavirus pandemic. Deon, having that mortgage background, he's going to talk more on the home ownership mortgage side, and I am going to talk about the tenant side, the landowner side, the landlord side from the tenant eviction side. And when we're talking there's a lot of carryover between the two, but the main things are with the moratorium is that it's a moving target, and the laws are changing relatively frequently. California just put out a new regulation that came into law in September of 2020. That's AB 3088, and that laid out new ways that tenants have to interact with landlords to make sure that the landlord, if they want to evict for non-payment, they do it the right way, and the tenant, if they're going through financial issues, they have the ability to stop any type of eviction action against them if they take the necessary steps. Now, the key to this law, the key to all the rental eviction moratorium laws are almost all of them are talking about deferments, and they're not waivers, they're not excuses of rent payments. They're allowing people to hold off on their payments, but they do require a catch-up payment, and usually that catch-up payment is going to be due within January 2021 to the end of January of 2021. So, under AB 3088, the catch-up payment is at least 25% of the rent owed from September through the end of the year. So, that's a big step that people have to keep in mind because, when you're looking at piling up rent payments and mortgage payments, as Deon is going to talk about later, you're not going to have the ability all the time to make those huge catch up payments. So, planning ahead still is the key to making the right steps in these unfortunate situations. Now, from the landlord's perspective, this moratorium is not a complete bar to eviction. Now, if somebody is cooking meth in the kitchen and doing things that are illegal, you can still evict. You still have the right as a landlord to make sure your property is used in the way that's complying with the law, used in a way that's complying with the lease. So, you still have rights as a landlord, but at the same time, you don't have the ability to have a non-payment turn into an immediate eviction if you don't follow the exact steps of AB 38 and the local rules that you'll see in the city of Chula Vista, city of San Diego, city of La Mesa, all across the board. From the tenant's perspective, as long as they're providing notice of their inability to pay with proof of the non-payment and the reasons for that, then typically they have protection, at least from the standpoint that the landlord can't take immediate action on the eviction. So, again, everybody's situation is a little bit different. Even the way the law is set up now, depending on when you stop paying rent as a tenant, that does determine what your rights are and what your options are for working things out with the landlord. Now, Matt and I, we were actually working on a project just recently where we came into a property that was a distressed situation. The tenant hadn't paid rent for over 9 months since before the pandemic started. And there was something where the landowner wanted to get out of the property. She was somebody looking to retire, somebody looking to um, take her money from the property. She owned it outright. She had all the equity in the property, but she just couldn't deal with the tenant not being able to pay rent. So, in these situations, the tenant, if they have, taken the steps to provide notice and do the other things that they have to do to avoid eviction, they could have had the protection there. But, there are options around that. And that's where, our company, Home Free Solutions, our consultants comes into play, and our solution based model where we try to work out resolutions between a tenant and the landlord. Here, we use something called cash for keys, where you negotiate a dollar amount, a move out date with the tenant, and that agreement is the tenant moves out by that certain date. Any unpaid rent that they owe, they don't have to pay that. They might receive a little bit of compensation to help them move out, cover moving costs and expenses, but as long as they move out by that date, both parties are able to move on freely and move on with their lives. Now, if they violate that agreement, they don't move out by the certain date, they don't do what they need to do to comply with the terms of the move out agreement, then the landlord still has their rights to move forward with action, as the law requires and allows. So, those are the types of solutions that we're trying to work on the tenant side for landowners and homeowners. Deon, maybe you can walk us through from a homeowner's perspective if they're dealing with payment defaults, pre-foreclosure notices. What can they do in these situations?
All right, cool. So, I mean, honestly, a person that's in that situation where whether it's them personally, like they're the ones that's in trouble, having problems making their own payments, or just kind of go piggyback off your example, if they're a landlord and they have tenants that are not able to make their payments, they can. One of the simplest things that people are doing right now, and the easiest things where it might just take a simple phone call, is a forbearance program. And so what that program does is it allows the homeowner to simply not have to make their payment for a certain period of time. Most people are getting, or most lenders that I know of are giving like 3 months extensions at a time. So you might be able to go 90 days without having to make a payment. Then you'll check back in around that time frame and then kind of see what's going on with your situation. If you're able to start making payments, you can say, "Hey, lender, I'm good to go now. I'm back on track. I got a new job. My tenant's paying their monthly payments now. I think I can start making the payments." And then you can go ahead and then start, you can go ahead and start getting back on track with making your monthly payments. Let's just say if you're not able to do that after the 90-day term, you can do a couple things. You can ask for extension, another 90-day extension, or some people are doing more than 90-day extension. It just depends on how the lender's set up. I think a lot of them are doing 90 or maybe 60 or 6-month extension. So it just depends on the kind of situation that you're in. So those are definitely things that you can do to try to get out of it. But if you're going to do a forbearance program, some things that you definitely have to watch out for is the way you set that program up, because that could lead to what's going to happen with your property once those forbearance options are no longer available and once they're expired. So you got to make sure that you set yourself on a program that you think you're going to be able to get out of, push come to shove. You know what I mean? So what I mean by that is a lot of times they're giving people like 2 to 3 different options if you do a forbearance program. One of them is you can do a forbearance program, get a 3-month, 6-month, 9-month extension, whatever it may be, and then as soon as that period is up, you have to make a lump sum payment and get caught fully back up. So that's one option. The second one is that I'm hearing is a lot of people are doing the extension time period, and once that's expired, you have to start making a payment and a half. So whatever your mortgage payment is, you have to make that payment plus half of the payment until you get caught back up down the line. And so that's the option that people are taking. And one of them that's the rarest one, which I personally think is the only option everybody should have gotten during this whole COVID situation, is any months that you miss, those payments go to the rear of your mortgage payment. And you just never have to make any payments until, they decide they're not going to give any more extensions. And then that's the easiest way that I feel like people all throughout the nation could have set themselves up for success throughout these trying times. So, I mean, if you're able to get that one, absolutely take it, because that's a huge program that's going to allow you to set yourself up for success as well, for sure. But for whatever reason, a lot of people only get one of the first 2 scenarios where you're going to have to make a decision when that forbearance period expires and you have to start making payments. And so if you get into a situation where you have to make a lump sum payment and you're not able to do it, and you know you're not going to be able to do it, then the next option you might have is to possibly think about maybe selling it. And that's where you might talk to Adam, or if they have tenants and talking about the cash for keys type situation, you got to get a tenant out of a home that you own, or you can look at trying to use an agent that's going to help you list the property to get it sold before you lose it. Because the biggest things you want to do is make sure that you do not mess your credit up, because that's going to hurt you for any type of financing you want to do if you have to move on for that particular property. And so it's important that you time everything right, because you don't want to wait till the last minute. It takes time to sell a house, for one. Then it takes time for you to either buy another house or rent another home, or wherever the case may be. So you don't want to wait until the last month that you have to make a decision, or until your house is about to get foreclosed on because they no longer give you extensions. And it takes 3 to 4 months to go through a foreclosure process, unless you do some things that can possibly extend that. But you want to kind of know well in advance if you think you didn't find a new job because you got laid off during COVID, or let's say your income got reduced. That's happening to a lot of people, where the income got reduced once COVID hit, and they know they're not going to be able to make payment in half, and you're not going to be able to do it. You need to start making moves before you get to the point where you have to start making those payments, because then it'll start affecting your credit. And so it's just smart to figure out what your options are well before then. So you want to talk to somebody, a lender that can help you. There's things that you can do to where you can possibly get on track if you know that you're not going to be able to make the payments. You can look at trying to see if there's any way you can refinance, but most of the time you're going to have to be able to come up with a way to make the payments 3 months straight before you might be able to refinance. You might have to get called back up somehow, and then try to do a refinance. So there's a couple of different ways that you can look at trying to get out of it. Lastly, if the forbearance program doesn't work for you, or you don't really want to sell the house, you can maybe think about renting it. You know what I mean? That could be a scenario for you as well. If you can find someone that can come in and take over the payments, and then you can go on and then try to rent somewhere at payments that are more affordable for the time being, until you get back to where you can take back over your property or something along those lines. So there's a couple of different things that you can look at trying to do to help yourself if you get in that type of distress situation. It's just, talking to someone that can guide you through. I'm more than happy to help anyone that's in that situation. If you want to call me and run your scenario by me, I'm more than happy to sit down and kind of give you some pointers on what you can do to possibly get out of it. And I'm a straight shooter. I'll let you know if, trying to finance looks good, if maybe selling it looks good, or renting it out until you get back on your feet is the best option for you as well.
Okay, that's great information, Deon. We got a question. You mentioned, the best option, the option that you wished everybody received in terms of forbearance, was tacking on the payments at the end. How do people get to that option, and who typically has that ability to get there? And what advice do you have for somebody who's looking for, taking advantage of that type of setup?
Well, it comes from your current lender. So whoever you have a mortgage with right now, that's the person you have to talk to. And so you're going to call their customer service department and ask to speak to someone in that department that can help you with the forbearance program. And then, you can request it and see what they say. But a lot of times they might already have set programs that they're willing to offer people. And I don't think it's based on you as far as, your abilities to pay or anything like that. I think they just have set standards that they do across the board. From what I heard from everybody, from what my company does and what I heard from other people, they give the same options to pretty much everybody across the board. Okay. So it's going to be one of those scenarios for the most part, but you can always request it and see what they say. Let them know your hardship and see if they want to do something different for the most part. But like I said, they normally give people those options. The 1 and 2 options where, you pay payment in half once you start making payments, or you pay a lump sum and get called back up right away. So most people are getting those 2 options, which I really believe the third option should be the only option. That would be a great way to help the nation get back on their feet, for sure. If once the forbearance options are no longer there for you anymore. So right. I'll say if people are smart, if you are on a forbearance, you should be saving your money. You know what I mean? Don't go out and start buying cars and big screen TVs because you don't have to make a mortgage payment. You got some kind of funds coming in. The smartest thing you could do is save that money. Save as much as you can. Pay whatever bills you got to pay, or pay off your credit. If you're going to do something, pay off your credit cards. You know what I mean? Put yourself into a better financial position. So if you do have to make payment in half or something, you can do it. So if you don't have to make mortgage payment for 9 months in a row and you were still getting $2,000 or $3,000 coming in, that's a good $15,000 to $18,000 that you could use on something that's going to better yourself. So be smart and do that with your funds instead of going on trips and doing all this other crazy stuff that I see some people do, unfortunately. So that would be my best advice to people.
Because you mentioned earlier that you can, in certain situations, you can take that money that you're saving up and pivot that into a new property and, move out before you lose that, take advantage of your equity.
Exactly. That could be a down payment on the next property. You know what I mean? That could be down payment. And luckily or prayerfully, if you have equity in the house that you didn't make payments on for the last 9 months, a year, whatever the case may be, when you sell your house, you might be able to walk over with some funds too. And that could be maybe a down payment on another smaller house that you can afford at your current income level. So sometimes you got to go backwards to be able to go forward down the line. You got to do what you got to do. You know what I mean? So it's all about knowing what your situation is. And me as a lender, if someone would come to me and tell me what the situation is, I can say, hey, if you not got rid of this house, but if you sold this house and based on your current income levels, this is the type of house that you'd be able to qualify for once that one is sold and you want to buy a new one. And you can see if that puts you where you want to be if you're happy with that. Some people might want to do that no matter what because, they just feel more comfortable at a lower monthly payment than where they are right now based on what's going on in the economy. So,
right. That makes sense. So talk more about, things. You mentioned some things that people can do to get ready to purchase, whether they want to purchase a property just for their primary residence or they want to purchase an investment property that, they might want to put money towards something that has some rental income upside. What should they do to prepare themselves to be a buyer, investor, somebody who wants to get in the real estate market?
Well, the first thing I would say to do is talk to a lender. That's absolutely the first thing I would tell you to do. Talk to a lender ASAP. So even if you're not planning on purchasing until 3 months, 6 months, a year, it don't matter. Talk to a lender right away so they can put you on a fast track to where you need to be. You know what I mean? Because you want to get your credit ran. You want to see where you stand. A lot of times people will be like, oh, man, I just want to wait till I see a house that I want. Well, guess what? That's too late. These houses are flying out. It goes on the market one day and it's gone the same day. You might have 20 offers the same day. So if you see a house that you want, that's not the time to try to worry about if you need to fix your credit or not. You want to do that well in advance. So you want to let a lender that you know and trust and run your credit ASAP, take an application on you, tell you where you stand. And if you do have to fix some things, if you do have to fix your credit, you got to pay off some debts. You got to save up some funds for, to have money for a down payment or closing costs. You need to get your credit score up to a certain point so you can qualify for a down payment assistance program, wherever the case may be. They can teach you that. And you can be working on that over the next 2 or 3 days, 2 or 3 months or wherever the case may be. So you'll be ready to go in the near future. So that would definitely be the first thing that I would say that someone should do is figure out where you stand. And also a lot of times I always hear people say stuff like, oh, I know what my credit is. I have Credit Karma or I got an annual credit report. People need to understand that's not an actual mortgage industry credit report. And so that score could be a lot different than what it would be for me if I run your credit. And on top of that, the mortgage industry credit report, I believe, is the most strict one you can have. So it has different algorithms, the way it generates your credit score. And so what you're looking at might be a totally different score than what I might see. And mine could be a lot higher. It could be lower. Either way, it could affect what you're going to buy one way or another. And so it's important for you to let us show you actual mortgage industry credit report and then let you make moves based off what you see there. So that's something I definitely think people should do first. Also, another thing I was saying too, or another thing I want to talk about is a lot of things that happen that people do to kind of hurt their options is they go out and run up credit. People still start shopping. Maybe they want to buy furniture. They haven't even found the house yet, but they're ready to go buy furniture. I see people do it all the time. I think he's trying. Is he trying to ask a question or something? The Ryan guy? Oh, I'm sorry. I thought he raised his hand. All right, sorry. So, I see people that go out and they start running up credit. Then I see people that buy cars. That's one of the biggest problems we have is people will go out and buy a really nice car right before they get ready to buy a house. And people need to understand that those car payments, especially if you buy a really nice one where you got, $500, $600, $700 monthly payments on that car, that's probably the equivalent of a good anywhere between $100,000 to $150,000 possibly of purchase power that you just took away from yourself. Mm-hmm. And that might totally change the area you move to. That might change the neighborhood, the school district that you want to be in for you and your children. That could greatly affect if you're going to be able to move to the place that you want to be. And it might even take you away from being able to buy a house, period. It happens all the time, believe it or not. And so I always tell people, if you think about buying a house and think about buying a car, you absolutely want to find out what it looks like for you to buy the house first. Because it's a lot easier to buy a car with a mortgage payment than it is to buy a house with a car payment. It could be done, obviously, if you make a good amount of income. But for those people that, you don't make a substantial amount of income, but you still want to be a homeowner, you should absolutely look at trying to get the house before you buy a car, for sure.
Mm-hmm.
Let me see what else. Another thing too that people sometimes do that kind of hurts them is if they start getting funds from people. Like if someone's going to help you buy a house, it's like something simple. You think, hey, I'm getting help from somebody. It should be a good thing, but it could be a bad thing if you start getting people that start giving you funds and doing all these deposits into your bank accounts before you buy a house. Because what happens is you get to the point where people start questioning if people are money laundering and things like that. So I always tell people, don't have anybody give you any funds. If they're going to help you, talk to me first. Let's wait till we get to the process because they can easily wire funds straight to escrow. We don't have to worry about any questioning coming up because it could be funds that somebody might give you and we can't use those funds anymore. They have to back it out and take it away because they don't want to show proof of where those funds came from. Some people don't feel comfortable showing their own bank statements if they're not involved in the transaction. You know what I mean? Especially if you get money from grandparents for whatever reason, they don't like showing their bank statement to anybody. So just want to tell you, I hear grandparents and they helping their grandkids out, they be refusing to show their bank statements because they gave their kids thousands of dollars within a 2-month time period of us looking to buy a house, and then we have to ask them to show their bank statements so we can make sure nobody's money laundering, and people don't want to do it. And then it'll force people to have to wait a couple of months before they can buy a house or something like that. So those are just some of the little things that people do to affect themselves when they're trying to buy a house. So I just definitely say talk to a lender first, find out where you stand credit-wise, income-wise, debt-wise, all that good stuff. Then make sure you don't do anything that could hurt yourself. Don't go any late payments or anything. Don't go open up any new credit card debts. Don't do any of that stuff. Just see where you stand and then let somebody teach you where you need to be so that way you can get where you need to go.
Okay. I think those are great points. And, a lot of that correlates to investors looking to get in the market too. The market is just as hot for investment properties and fixtures. I know, Matt, you've seen how quickly, a house can have 20, 30 offers on it based on it being in a fixture market. And then, making sure you're preparing yourself to be, whether you're a buyer or you want to be an investor, other investors, investment groups, they do credit checks on people as well. And if you have child support issues or outstanding debts and liens and things like that, you're not a viable candidate to be part of investment groups because those issues sometimes can carry along with the person into the asset they invest in. Nobody wants to be part of a group where somebody can potentially suck all of the equity out of the property through their creditors or through issues that they're bringing into this situation. So that's great points to talk to you, Deon. And then in terms of preparing, you mentioned forbearance situations and getting started early. How early do you suggest people get started in terms of making sure they know where they stand in terms of being a purchaser or an investor?
I would probably definitely say when if you already got one extension, after you start getting those second and maybe third extensions, you probably, I don't know how many they're going to give people. You know what I mean? It's like sooner or later, the well is going to dry up at the end of the day. You know what I mean? They're not going to let people continue to go forever without making payments. So I would definitely say more than likely, the lenders are probably going to send a letter, or they're going to tell you when it's your last extension. And as soon as you find out that you can no longer extend again, that's a time where you probably absolutely need to start figuring out an exit plan or figuring out how you're going to get yourself out of the situation. As far as what kind of moves you're going to make. But I would say to prepare for it, you want to do that day one. So when I went back to saying don't start spending all your money on stuff that's not going to help you when the forbearance option is no longer there, that's when you want to start doing it realistically. Like save that money. Like if you get stimulus package, save that money. Don't pay what bills you have to pay to survive. But above that, start saving because you might want to do a refinance. And so, if you have $7,000 saved up where you can get called back up right away and then go ahead and do a refinance and maybe take cash out, you could probably get it back if you have enough equity in your property. So that's what I'm saying. Save it in case you do got to give that one big lump sum just so you can be able to refinance right away and do what you got to do, or refinance within a 3-month time period. But I think they changed the guidelines where you can actually refinance. If you can get caught up fully and show that you're off the plan, then you can refinance right away and you might be able to take cash out and get those funds back. And then some if you have enough equity, because a lot of people are getting equity right now. Like it's crazy right now. So if you haven't been making payments since like February, March, your house probably shot up in value to where you want to keep it. You don't want to lose it if you don't have to. And you might be able to take cash out to help pay off all your other debts if you can. That's going to help you too. So that's why you want to try to help set yourself up to get back into a position where you can refinance if that's going to be the best thing for you to keep the house or put yourself in a better financial position. The rates right now are the lowest they've ever been in history. Ever. So I tell people all the time, like, if you don't want to do some type of financing now, whether it's buy a house or refinance, like, when are you going to do it? You can't give me another time to do it rather than now.
Mm-hmm. Somebody just asked, what are the rates looking like right now?
Well, I always have to say, based on your situation.
Right. Yeah.
So we 100% clear. There is no set rate for any one person. It's always case by case. But what I will say is the lowest rates that I've been getting people recently, which I feel like is the lowest rates ever, and I don't know if anybody else has got anything lower than this, is 2.25% on 30-year fixed for like FHA and VA loans. So that's the lowest I've been able to get several people recently. Again, and a lot of them did not have you didn't have like a 700 plus FICO score. Some of them have credit scores in 600s, and they might have been willing to do like a little bit of a buy down, something like that to do it, but it's worth it. If you could do even a 1 point buy down, whether you pay $2,000 or $3,000 to get your rate down lower, but you're saved $10, $20, $30, $40, $50,000 over the life of the loan, that's an investment worth doing. You know what I mean? So I always sit down with people and show them the difference. Like, hey, this is where your rate would be if you didn't do a buy now to get down to 2.25 or whatever rate we're trying to get down to based on qualifications. And that's what it would be if you didn't. This is how quickly you can get a return on that investment. Normally a good return on investment is anywhere from like 2 to 3 years. If you can make your money back in that time frame, that's probably something that's worth doing. And at 2.25, you're probably not going to refinance anywhere near in the next 2 or 3 years unless something super crazy happens and the rates drop well below that. You're probably going to keep that loan for a long period of time. So a good 2 to 3 years, if you can make the money back, the cost, whatever it was to get down to that rate versus where you would be if not doing that buy down, then I'm doing it myself. So I'm refinancing my own house and I'm getting down to 2.25. I'm paying whatever the cost is. So I promise you I'm doing it right now as we're talking right now. So I don't preach to the choir. I do what I say. I teach people to do it as well, but I show you the benefits. So some people, it may not make sense to do it. Some people do. So I don't talk to people just to do it. If it doesn't make sense, I'll let you know.
Gotcha. So you're practicing what you preach.
Yes, sir.
So before we get into the investment, we had somebody asking about, the situation. If you're in forbearance, can you still get those type of rates if you're in a forbearance situation?
Yeah, as long as your credit score is where it needs to be and you meet the minimum requirements to be able to do financing after coming out of the forbearance program, they're going to treat you just like as someone who wasn't in a forbearance program. You know what I mean? You get to the point where you can refinance, it's all just going to be about your credit score, the type of loan you're trying to do, you're trying to get cash out, whatever the case may be. So they're not going to hit you for anything, so to speak. They're not going to dock your rate or anything like that because you came out of forbearance program. It's just, you just got to get to the point where you can finance again. And then whatever your qualification called for, that's what you're going to get.
Yeah, I definitely agree. I got about 4 or 5 rental properties, and some of my tenants stopped paying. And I actually myself took a forbearance on 3 or 4 properties. And again, I have like a 750 credit score. Once everything was over, I sold some of the properties. Some of the people started paying again, and my credit score wasn't affected at all. And I think that the government set this up so if you did it the right way, if you went into forbearance before you started getting into any kind of real trouble, that it didn't affect your credit at all. So make sure that if you are getting into a situation where you're close, and I wasn't close, but the whole point is, at the end of the day, why not take advantage of it, right? If you can get into forbearance and I'm not getting rent from my tenants anymore, why not jump in for a little bit? Make sure I can either get the property sold or get them back on track, right? So at the end of the day, I did it for. I care about my tenants, so I actually said, "Hey, look, I'm gonna go on forbearance. Get yourself together. I know you lost your job, and gave them about 5 or 6 months to kind of get their stuff together. I didn't charge them any rent, and then when they said, "Hey, we're back okay," then I got off forbearance, and then we started back just anew. And I took the hit. I mean, at the end of the day, those 4 months or 5 months went to the back of the loan. But at the same time, it would have been a hassle trying to get a tenant out that's been in for 10 years, that's always paid on time. So it was just one of those things where you eat it for now, but I've made the equity up 2 or 3 times over during the year. So it was just right in me to do it that way.
Right. Exactly. You're one of the lucky ones that got to put it on the back of your loan. So that's good.
Yeah. So I was with Wells Fargo, and Wells Fargo actually, I really didn't even have to ask. They kind of sent out the paperwork saying, "Hey, if you need forbearance, just let us know, and we'll just immediately stop your payments." And I just called and said, "Hey, this one, stop it." And then they said, "Well, can you pay the other one?" They say, "Yeah, I'll finish paying the other 3 or 4. But these ones right here, stop for now." And it wasn't even an issue.
I see someone asking a question. You want me to answer this one? How long does your work history have to be?
Go for it.
All right, cool. So when it comes to work history, there's a lot of different reasons as how far back you need to be working. Technically, they like to see like a 2-year work history, but it does not have to be in the same history. I mean, excuse me, not same history, but in the same field. A lot of people think that you have to be working the same job for 2 years. That's not accurate. If you're doing a W-2 job, where you get pay stubs and things like that, as long as you have a 2-year work history working at, they don't like to see 3 different companies within the same year. That's kind of a no-no. So if you've been 1 or 2 different jobs in the last 12 months or so and they're W-2'd, as long as you can show like a full 2-year history overall, you might be good to go. And so we just look at that and check it out and make sure you meet the minimum requirements for us to be able to do a regular loan. As long as you have just kind of like a 2-year history. There are some programs where you can do a loan with a 1-year work history as well. We just have to we have a program called Desktop Underwriting, which is an underwriting system that we use. It's a computerized one, not an actual human, but a computer one. If you run numbers through that and only ask for 1-year history, you might say, hey, we only need 1 year's W-2s or a 1 year's tax return, or even just a most recent pay stub, depending on what kind of finance we try to do. Sometimes we only got to show a pay stub for you to qualify for a loan. It's that crazy, if your situation is good enough. But as far as work history goes, if you're doing regular jobs, 2 years, but it could be different jobs as long as they're W-2 jobs. Now, if you have someone that is self-employed, you can't go from a W-2 job to a self-employed job. They're going to make you wait a full 2 years more than likely before you're able to do any kind of financing. So if you go from self-employed to W-2, you may be able to finance depending on how long you've been at that W-2 job, especially if you get a salary job. That's always the ideal situation. If you ever get any kind of job that's W-2 where you're going to get, not self-employed, try to get something that's salaried. They always bend the rules, not bend the rules, but it's a little more flexible, but they'll let you finance a lot sooner if it's a salary job. Also, another thing that a lot of people don't know about is if you were in school, this is a big thing that helps a lot of people that for whatever reason a lot of officers don't know about, that can help people bridge that 2-year gap history. You can actually use school time to go with work history to complete a 2-year work history. And so what happens is I always ask people, hey, if they only been working for a year or so, what were you doing prior to that? Oh, I was in college. Okay, great. Did you complete did you finish college? Yes. All right, cool. As long as you're able to show a transcript that you're at least a year prior to that and then on, plus the year of work, I might be able to use that to call it a 2-year work history. And it doesn't even have to be a full year. Like I had 3 gentlemen that were all in college. They all started working at Qualcomm. All of them right out of college were making $100,000 a year. Within 2 months of them getting out of college, I was able to use their whole 2-year school history plus their salaried income because their school actually, I guess, had job placements for them. So they all got the same job at Qualcomm at the same time, making the same exact $100,000. And they were able to all 3 of them go on one loan and buy a house coming straight out of college. And so there's things that you can do like that a lot of people don't know are there for you that can help someone buy a house where, unfortunately, some of the lenders don't know about these type of little, guidelines that can help people purchase a home. So if you went to school, college, you can add that to your work history and try to get to 2 years as well, too.
Okay. That's good information. I'm sure that can help some people try to bridge that gap, like you said. As we get more into the question, we're getting to the final 20 minutes of our hour. Let's talk a little bit more about investment properties, Deon. I know that people probably come to you looking to buy, duplexes up to 4 units sometimes. What is the difference there in terms of people looking to get into investment properties, whether they want to buy as themselves or put into an LLC or something like that, or a trust or anything like that?
Well, when it comes to investment properties, there's a lot of things you just kind of got to watch out for because there's some like little tricky guidelines that might prevent you from doing some things that you may not find out until you get well to the end of the process and you want to end up being able to buy the house. So just one that gets a lot of people right now. Let's say if you're trying to buy a multi-unit property on FHA, maybe like a 3 or 4 unit property, so that, a government loan, they have a thing called a Self-Sufficiency Test. And so the rents on that property have to come back and be more than 125% of wherever the payment's going to be, or else you can't buy the house with FHA if it's a 3 or 4 unit. Now, they don't do this test for a single family home or a 2-unit property, but 3 or 4 units, you got to make over 20, your monthly payment has to be 25% above whatever the monthly payment is going to be, of the, 25% of the monthly payment. above the monthly payment. So that's not that easy to do. Trust me when I tell you, it seems like it might be easy, but it's not. So you got to kind of watch out when you're looking at 3 or 4 unit properties if you're trying to use like a government loan. VA doesn't have that, so VA you will be okay. And I don't think Fannie Mae or Freddie, conventional loans don't have it either. So you might be able to get away. But if you're trying to do FHA, you got to watch out for the self-sufficiency test. So that's like a little tidbit right there that hits some people when they try to do that. Is just looking at also there's different ways you could possibly use rental income to qualify, depending on the situation. If you have landlord history, if you've been owning a home if you already have landlord history, you can possibly use the rents to qualify for a house. If you don't have landlord history, depending on the loan program, you could possibly use some of the rental income. It just can only offset the mortgage payment. So you can't get more income than whatever the mortgage payment is going to be. And you can only no matter what your situation, you only get 75% of whatever rental income is. So what I mean by that is if you're going to get $1,000 in rents on a property, they only going to give you credit for $750 no matter what. And you have to use that to qualify. But I mean, if you don't have any landlord history, let's just say your mortgage payment was $600, but your rent what you're going to get on that property was $1,000. They only going to give me credit for $600 because you don't have any history. So I can't get 75% on that if you don't have any landlord history. They're going to make me only match whatever the mortgage payment is.
Okay.
And so in a normal situation, you should still be able to qualify, but that's just how the rule works. So we just have to watch out and kind of figure out where you fit in at, what kind of program will work best for you. But there are some people that can use rental income from multi-unit properties to help qualify too, which a lot of people don't know about also. So, I mean, any other question you had about that, like as far as investment properties?
I mean, I think that was a lot of good information there. And then, we had a question earlier about buying as an LLC versus buying as an individual, qualifying as a business. Do you handle a lot of those situations? And if so, what are some of the main differences that people should watch out for, like business credit versus personal credit?
I believe the proper way to handle that situation is probably to buy the house under your name and then change title into the business. Now, the thing you got to watch out for is if you're buying a property that looks like it's a business, then you're probably going to have a problem because they're going to treat it as a commercial property. So I actually had a situation come up recently where someone was buying a house that was a home. The previous owner turned into like a bed and bath. And the new owner that was going to buy the house wanted to turn it back to a home. But because the previous owner literally turned the property, you can see like they had like a whole desk and everything. You can tell it was a business there. And so the problem we ran into was there was the appraiser that came out and looked at the house and came up with the value, said, hey, we feel like the highest and best use for this property is as a business, not a home. And so the person wasn't able to complete the transaction as a home because they said, no, this looks like it's going to be used for a business, not as a house that you're going to live in. So you got to watch out for that. Like if you're going to do like a daycare or something like that, that's where you can, you easily do something like that where you buy the house as your own house and then turn around and change the title to the name of the business. I think you should be fine to do it that way. But if you're trying to buy actual business, it has to be a commercial loan. Then you got to do commercial financing for something like that. But if you just buying a regular house, buy the house and then put in the business name. But you talk to your tax provider and whoever, your CPA, whoever, to make sure you're doing everything the right way and for tax purposes and stuff like that. I can't give any advice on that, but I believe that's the way it gets done. Let me say it that way.
That makes sense. No CPAs here. Another disclaimer.
Yeah, exactly. I'm not a CPA. I can't tell you how to set yourself up for tax purposes, but I can tell you I heard that it gets done like that. And, talk to the guy and see how to do it.
Okay. We had a question about, you mentioned the 2-year gap and using education time to cover that time. What about somebody coming straight out of boot camp? Can they come out of boot camp and use their VA loan to purchase right away?
Yeah, you can, because they know that. Well, let me rephrase that. They're gonna, as long as you have at least like probably a more than a year left, then they're going to be okay allowing you, because they know the military is very stable and you can't get out unless something bad happens or you take out medically. So more than likely you'll get an honorable discharge, and they'll let you buy a house going into the military right away, knowing that most people have at least 2, 3, or 4 year tours or more in some situations. Now, if you get to the point where you have a year left, that's less than a year left. That's when you might have to prove that you're going to extend or something like that to be able to buy. But when you do that first year coming in, you should be good to go. with purchasing a home, I think you're going to be okay.
Okay. What about reserves?
You should be fine with reserves. We just got to look at your income. So if you're doing reserves and you have just a regular job as well, we just look at the income for both. As long as you have access to your VA loan, you got to make sure you're eligible to do the VA loan, then you can do that for sure while you're in reserves. We do reserves all the time. So there's no problem with that whatsoever if you're reserves. It's just you look at all your income and your credit score and figure out what you can qualify for and go from there. Simple. It's easy.
Gotcha. So Matt, we've been talking this whole time about people wanting to buy and be purchasers, and obviously, like Deon was talking about, you have to be qualified and get the mortgage. Now, there's situations where people can't qualify for a mortgage necessarily, but they have cash that they want to invest and get into the real estate market. What are some ways that you work with people to make that happen?
Well, I mean, let's be realistic. There's a couple things happening right now in the market, right? So, one, baby boomers are leaving and exiting the market, right? So, there's a lot of money, there's a lot of wealth being transferred. When you keep hearing these things like, "Oh, there's a transfer of wealth," there's a couple things happening, right? So they're getting rid of a lot of medium and small business, and baby boomers are starting to transfer into retirement. So things are going to start happening that are going to create a lot of wealth for some people, and then there's going to be a lot of people that are going to spend a lot of money quickly, right? So let's be realistic. Right now, what we've been seeing is a lot of people that are getting inheritance from their dad or their grandparents are starting to give them their homes. And a lot of these younger people are just like, oh, I'm not in California anymore, so I'm going to sell my house and I'm going to sell it immediately. So they're not even really caring about fixing it up. So they're at this point they're just taking the house that grandma lived in from the 40s, and they're saying, hey, find a wholesaler and let's get it off. Let's go ahead and sell it. So these are small things that are starting to happen. So what we've been doing, me and Adam, is putting investment portfolios together and basically helping people bring their money in so we can invest in different properties, right? Because at the end of the day, what's going to eventually happen is, if we pull all our money together, we'll be able to go into properties that have been sitting for 30, 40 years and haven't been touched, and add value to them in different ways. Right now, with San Diego alone, because of the housing crisis, is doing a lot of great things, right? So there's density bonuses. They've changed the ADU laws where now you can do granny flats.
Yeah.
I'm sorry. Is somebody speaking? Okay. Well, yeah. So with the ADU bonuses, ADUs and granny flats, things like that, San Diego has definitely became a hot spot for adding value into properties, right? So what we've kind of done is started to pool investments. So people putting in 10,000. We had people like Matt and other guys putting in $100,000 to $200,000 in with us on some of these properties. And just to give you an idea of what we've done, so we'll take one property, one of our Florence properties. We bought it for $375. Bought it knowing that the property was set up for duplex, right? So a quad in the back. So we bought the property. It's on 9,000 square feet. It is zoned for one unit per 3,000 square feet. So what that means is every 3,000 square feet, you are allowed to put a house and a auxiliary dwelling and or a garage or something like that. So knowing that on the first 3,000, there's a house and a garage. So we've already put permits in. The house was a 2-1. It is now a 3-2. The garage is now turned into a 2-1. With the back of the house, we're going to build a quad, right? So with that quad, there's a couple things that we've kind of looked at, and me and Adam been playing with, and we're gonna maximize this value. So there's two ways we're gonna go about it. If we're able to build a quad, we'll take 1,000 square foot quad and we'll build studios into those quads, right? So now we're looking at one apartment complex that might be 1,000 square feet. We'll build 3 studios inside of it and rent those out, maybe 4 studios inside of it. If not, we'll go through the container home portion of it and say basically, okay, if you let us build out, 4 units for 1,000 square feet, we can technically do 3 container homes per unit, and that will still put us 12 doors, right? So if you think about this property, right, we put in $375. It's going to cost us about $50,000 to $60,000, maybe $70,000 to do the front of it, to put it into a 3-2 and do a 2-1 garage. To go into the back, we're probably going to have to do permits. The permits might cost us $30,000. And then to build the property up, say worst case scenario, costs us $300,000, $400,000. That property then turns around and probably going to be worth about 1.5 to $2 million. So we've pretty much put in, we've pretty much made 50 to 100% back on that money, where you can really go in and maximize the value, right? So I mean, we've taken a property like that and maximized it to the max. And again, we're doing it 3 or 4 different ways. We have another property right now that me and Adam just closed in today. It's on Lisbon. It's right next to the Barrel. So if anybody knows where the Barrel is on Skyline, it's 2 houses down. That house is it's a 2 bedroom, 1 bath, but it's already set up like a duplex. So we're gonna basically cut that house in half, turn it into a duplex. It's already set up for a 2-car garage. That 2-car garage will turn into another 2 bedroom, 1 bath. And because of the density bonus, because it's next to the trolley station and to bus stations, we probably are going to be able to get 1 or 2 granny flats back there. And at that point, we can use containers or we can build. So that property probably will have 6 to 7 doors on it. And you're talking about a property that, again, we bought for $400,000 that now we're pushing into million one, something like that. And there's a lot of room for growth in these properties, right? So we've been taking people's money and helping them do that. So what we're looking to do is bring on partners, right? And at the end of the day, we know, everybody's not rich, right? So we know that, it might take 10,000. Some people are coming in with 20,000, and we're teaching them. So we don't just want to get you in and say, hey, thanks for your money. We're going to give you your 10% back in a couple months, and then you'll be good to go. We're bringing in partners for a reason, because me and Adam have a website that we're getting a lot of people coming in. We're getting a ton of people coming into this business, and they're bringing us houses, they're bringing us properties, they're bringing us all these things. And at a certain point, we're not going to be able to handle all of it. So if we teach different people, like I know Nick is on the call, my buddy Nick. We've talked a couple times. Get to a point where he learns how to pick up houses. I got other buddies that they learn how to pick up houses or how to flip houses. Now we can spread out and we can start to do multiple things in multiple sites, because at the end of the day, I can only handle so much, right? Adam can only handle so much. My partner Reese can only handle so much, and we're getting to the point now where, I mean, like, I'll be realistic. I'm flipping 7 houses right now, so I'm almost at my limit. So and we still got 2 more houses that we're supposed to be looking at later on this week. So at a certain point, we're gonna have to bring on partners, because it's not even about the I know there's a ton of money there, but it's not even about the money. It's about the capability of us being able to handle that much. So we're bringing on partners now. We're bringing on good people now, because at the end of the day, if you look at our website and what we're doing, we're helping people, right? So we are bringing in people that are having tenant issues, that are having forbearance issues, that are having marital issues. But with all those people coming in, there's a lot of people that are going to Adam and saying, hey, you know what? I'm done. I don't want to deal with this tenant. Adam, can you cash me out? Can you find me a buyer? And we're saying, hey, well, okay, there's a ton of equity in this property, or a good amount of equity in this property. Hey, we have avenues. I might be able to send it to Nick. I might be able to send it to my other buddy Matt. Might be able to, hey, Deon, do you know somebody? So at the end of the day, it's starting to form a real good relationship, and we're just trying to bring good people in that we can trust to move with these products. So at the end of the day, I mean, if you're looking to invest but you don't have all the money together to buy a home just yet, talk to us. We can help you. We can help you get you on the right track, so you can learn how to flip. You can learn how to invest in property. And at the end of the day, just learn, right? Everybody, you might get in it, and you come with us and you start learning, and you might go, this isn't for me. And if it's not for you, then turn around and go on doing what you need to do. But at the end of the day, there's nothing wrong with learning a skill that people throughout history have become millionaires behind, right? Let's be realistic. If you do the research, 70% or more of people that have made millions have made it in the real estate industry. And right now, once this forbearance law clears and people can start getting kicked out of their homes, and people end up going to court, and now they got to pay back 8 months worth of rent and things like that. Because at the end of the day, some people are doing the forbearance, but a lot of people right now are mad at their tenants. I have a next door neighbor right now, and he has 2 properties, and he's taking both of them to court because he feels, again, an older gentleman, he feels that they are robbing him, and he's going to go to court and he's going to try to get every penny back. And if he doesn't, he's already said, hey man, once I get my money back from him, Matt, I'll give you a call. And I just want to get these properties done. I got about $300,000-$400,000 worth of equity in them. I'm gonna sell them, and I'm just gonna go live my life, go camping, go see the world. And that's what's happening right now. So at the end of the day, Don't be scared to jump in these things. Don't be scared to start investing, because this is going to be a true confirmation of people becoming millionaires overnight, or not overnight, but I mean millionaires over time with real estate and real estate investing.
Nice, Matt. That's a
You made me want to invest, man. How much money I gotta give you, man? I got a couple bucks saved up, man. We gotta talk. I'll be club.
Hey, it's the truth. I mean, at the end of the day, I mean, it's only the truth. Like, I'll be honest. I mean, at the end of the day, I started about 5 years ago in Atlanta with $5,000. Like, literally, I had $5,000, and I bought a house in Atlanta. It went up in property. It went up a little bit, and then 6 months later, I bought another one, and I ended up getting 3 properties. I mean, at the end of this year, when I sell all these properties, I'll be up about $500,000. So at the end of the day, I'm not telling you, and you can ask Adam. I'm transparent. I don't hold anything back. I don't hide anything. Everything is, I'm upfront about everything. And what I'm telling you guys is that it's easy to do once you get on the right path. And we haven't even scratched the surface yet, right? We haven't even found the big investor that's going to say, hey, I'll buy Florence off you guys. And this is what me and Adam, this is what me and Adam's goal is. Once Florence is done, or once our properties are done, grab, say if it's worth $2 million, I'm not going to sell it for $2 million. I'm going to sell it for somebody's going to be able to buy 75% of it for maybe 1.7, 1 point whatever. They're going to clear out. So they'll clear out all our debt. And then me and Adam and whoever our partners are will get a residual income for the rest of our life. Right. So we clear the property out, we get a residual income, and now we go do it again somewhere. Right. We already have 2 more properties. We go do it again. And then we tell that same investor, hey, I got another property over here. You want to buy 75% of that one? Because think about it. I'm going to take care of them. I'm going to take care of the management. I'll make sure it gets rented out. And all you got to do is sit back and collect checks. But what I would want from you is, hey, can you fund these deals for me down the line? And if you're worth $30, $40 million, if you're a Charger, or if you're a Bengal, or you're a baseball player, why would you not want to be in a system where you're buying property at a lower cap rate? So you're buying property at a lower value, you're getting a higher cap rate, and you got somebody doing all the work for you. Mm-hmm. So in turn, we're making him a stable way to make money, right? And in turn for us, he's helping us become rich. So at the end of the day, it's a win-win effort, and all we're doing is using tax advantages and housing advantages right now that San Diego's offering that people aren't taking advantage of. And that's all we're going to do is use loopholes in San Diego's system to become filthy rich at some point.
Yeah, Matt, that's great. And people who are interested, I've seen some questions about how to get involved. Reach out to us. Let's talk more. We could talk offline and talk to people individually, learn more about what your situation is, what your goals are, and, just talk from there. But, we're interested in working with people. We're having these types of meetings with Deon and other professionals, other knowledgeable professionals out there, because we want people to be educated and be able to make informed decisions to help themselves and better their position in their life and their families too. Tell your friends and family about this, have them on the future calls that we have. We're going to continue to have these different topics. And Deon, we really thank you for your time to be part of this. It was a lot of knowledge there. So thank you again for being a part.
Oh, man. Like anytime, let me know, man. I'm here.
All right, appreciate you, Deon.
Ain't no problems. Definitely gonna talk for sure.
Yeah, and I'll just say this on closing. At the end of the day, we don't charge anything, right? You can always come by one of our sites. You can talk to us. You can ask us about hard money process. I've done 4 or 5 hard money loans. I've done loans where you brought in investors. Me and Adam are open books when it comes to knowledge, when it comes to where I've messed up at, where I've taken some hard hits. I've lost some money too. So I'm not going to sit here and lie and make you believe that everything's been sweet. I got run over by a contractor where he kind of came in and took some money from me that I had to learn the hard way about. I bought properties that were duds, and I had to turn around and sell them and take losses. So don't be hesitant to ever hit us up and say, hey, I just got a question. I just got to this is something that's been on my mind, Matt. We're always willing to help because at the end of the day, I don't care who you are, if you're a friend, if you're family. Once you join these calls and join our group, all I want to see is people succeed. So if I can help you succeed, you don't have to join us to succeed. You can, if I can help you, I'm going to help you.
Sounds good. All right. On that
All right.
note,
On that note,
I think Deon's going to post his information in the chat. So everybody, if you have lending questions, if you're trying to figure out a refinance, forbearance situation, definitely reach out to Deon. I've posted Matt and my information in the chat a few different places, but you can reach out to us. You can find us on Facebook. Feel free to reach out to us. We're always here. So thank you for being a part of this. Somebody just asked, if you want to get involved, yes, go to our website. On our website, you have an ability to schedule time to talk to us. We have consultations that you can set up and speak with both of us. So if you're interested in getting involved, please reach out, and we look forward to it. So thank you, everybody, for your time. Talk to you on the next webinar. Matt, Deon, anything else? Any final words?
I was just going to, I can help people whether you're in a forbearance program or not. So if you're thinking about possibly trying to buy a house or refinancing when you currently own, you want to buy investment properties, hit me up. Like I said, I don't mind planting the seeds. So even if you maybe not ready to buy right now, you absolutely give me a call. I don't mind, help you doing a free credit report, free analysis of your current situation, and let you know where you stand. And then after that, I'll be there for you. Until you get to where you want to be, until you're ready to make a move. I've been doing this for 15 years, so I'm not going anywhere. So it's going to take you 3 months, 6 months, a year. Don't matter to me. As long as we figure out where we are, and then we plan of attack to get to where we want to go. I'm here for you for sure. Give me a call.
Good. All right. Thank you.
Thank you guys for hosting. This was awesome. Thank you so much.
You're welcome.
Thank you.
Questions and joining.